You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome to the show, Bob.
Yes, Jim. Good to be with you, even though it is particularly bleak times in the financial market.
Well, you were telling me that the multi-year trend lines have been wiped out.
Yeah, a number of exchanges around the world. And the senior index in New York, the S&P, everything's getting hit. Basically, it's been huge inflation in financial assets, and now financial assets are deflating. And you see it in these, as I said, the senior indexes, the Shanghai index, which was on its own fabulous bubble, blew out in June and replicated on the way up the same technical features that it did in 2007, and it the bounce, the slide and the bounces since have been sort of following the Nikkei after 1989 or gold after 1980. So this is a big event. The fascinating thing is that in Shanghai, the policymakers are giving us it's these statements they've been making and the things they've been doing are not going to disappear. They have taken huge efforts to prevent the decline, and it's not working. Now, here's what I want to give you an example of: is that in April, the headline was that China approved 30 new initial public offerings, new issues, in order to cool a red-hot stock market. That was April. The peak in the stock market was June the 12th for the China. Then you got a July 3rd. So it was crashing so fast that on July the 3rd, policymakers say that China freezes IPOs in attempt to stem stock market bleeding. So on one month they're pushing the stock market up. 3 months later, they're trying to prevent it from falling. So this is amazing stuff. And there's evidence that it was similar in 1929. During the initial part of the crash, the New York Fed opened the windows and discounted. They bought bonds out of the market. The New York Fed exceeded its authority by a factor of 6 times. And then early in 1930, the Fed said that they had met the crisis in the usual way with counting. So, they're all the same. Now, the other thing that's fascinating in here, that although the U.S. dollar has been weakening over the past couple of days, the commodities, which are priced in U.S. dollars, are down quite hard over the last couple of days. So the only thing that's up here is gold. And, of course, this is what happens in a financial storm. The safe money goes to the most liquid items, which is Treasury bills in the U.S. Or in the senior currency, which is still the U.S. dollar. And at the same time, there's buying gold because it provides a unique liquidity. And then the other part you get in early stages of financial contraction is that silver can drop relative to gold. And indeed, it is today's, because silver's down 1% and gold is just barely slightly up. So that's another financial telltale here. You've got crude down to new lows. As I said, the whole thing is weak. And that's without a strong dollar. So I'm quite impressed by it.
Now, I understand a real estate expert told me that people like hard assets in financial troubled times. Is real estate one of those hard assets?
Well, it is a hard asset, but throughout all of history, it hasn't done so well in times of financial trouble. Of course, after the 1929 boom, well, actually, in that mania, the Florida real estate bubble blew out in 1926-27 and crashed hard before the stock market peaked in 1929, and that was a unique bubble. But anyways, if you take a look at any number of real estate items after 1929, they went down. Then going back to the previous cycle, 1873, I did come up with a chart for farmland values in England, which was then of course, the senior economy. And from the bubble peak in 1873 to the Depression bottom in 1895, that index fell from something like 58 to 38 on annual numbers, and with not 1 year of an uptick on it. So, and it's the idea that hard assets like land will do well in a post-bubble contraction, I think is somebody's opinion, not backed up by looking at history. So one of the ideal things to do, of course, is to pay off one's mortgage. You don't want to have debt in a post-bubble contraction. So just to put the bigger picture on this, of course, the bubble of 2007 had many of the characteristics of previous classic bubbles, such as 1929 or 1873, and that was confirmed by the fact that you then followed it with the worst financial collapse since the 1930s. Now, what we have been on since that panic ended in 2009 is the first business expansion. It's been weak, but it's been expanding, and the first bull market with that. So now we see that, I'd say that the bull market, as measured by the S&P, is over, and a little more work in here. Now, at the moment, the sentiment is very bearish, and the momentum is down, so who knows, there might be a bit of a relief for a while, but this is a very big shock to the system, particularly as the Shanghai Central Bank and Chinese policymakers were doing such a huge effort. They pulled out all the stops to prevent the market from going down. But I recall with the stock bubble in Tokyo, which blew out right at the end of the year in 1989, that going into the peak, there were utterances from policymakers that, we should try and cool the bubble a little. And then on the first crack into probably that February, then they were talking about lowering margin requirements in order to stop the decline. So I think a great financial speculation is sort of a fever period. People just go mad, and so do policymakers. They get this idea that all of this incredible paper prosperity is due to their brilliance in managing things. And going back to the Fed here now with their talk for the last year and a half at least about raising their administered rate and then not doing it, that's a major blunder in itself. But in looking back on it, I think that the talk about raising the Fed rate was to sort of show that they were thinking about being responsible when actually they were acting in the most reckless manner imaginable. So, and then now it's become the big thing, but no, it doesn't matter what the Fed does, because if you look back on those previous bubbles I've mentioned and look at the senior central bank, they were some 3 or 4 months behind the changes in market rates of interest that you get with the start of a bubble and with an end of one, and then going into the contraction. So the people who are guessing when the Fed will raise interest rates, it's completely useless. It's got nothing to do with it, as we're seeing now. These financial markets are failing with no change in policy at the Federal Reserve, which is fascinating.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Bob, what's your take on what's going to happen to gold right now?
Yeah, we've been looking at the gold itself became very overbought a number of weeks ago, down at that 1080 level, and also the commitment of traders figures were heading for a condition where it would give a buy. So we got the buy in gold itself in U.S. dollars, and it's had a decent rally, but it It's just been, I think, the two things going on here. One, technically, gold was primed for a rally in U.S. dollars, and then you along come with a financial storm whereby the world is going to add to its gold position. Now, I don't see any runaway market for the price of gold in U.S. dollars. And what we have here in the last couple of trading days is where gold has been firm. Silver, particularly, well, the last 2 days has dropped. And as I said, that silver falling relative to gold is a sign, or it confirms that you're in a financial distress. So this would really become more emphatic when the gold-silver ratio breaks above 76 here. That's one of our lines in the sand. The other one that has been very reliable for us this summer has been the course of U.S. credit spreads, the difference between U.S. corporate BBB bonds and long-dated treasuries. It narrowed into May, with the financial party, and then when it started to reverse and change to widening, that puts out a warning. So we looked at it, that spread, what it did in 1998, which was the disaster with long-term capital management, and that reversed in June, and then early July the spread did the first breakout. Then late in July it did the real killer breakout to widening, and that was something similar in 2007, which was the start of that credit contraction, and then something similar in June and July of 2008, which really started the crash. And we're right on line, maybe a week behind, that's all, but as of Friday's posting on that spread, it had broken out, did the second in what we call the killer breakout, and now it's extending it. So it broke out at 216 basis points, and now it's up to 222 for that one. It's moving quite quickly, and of course it's accompanied by severe pressures. So at the moment, and we would say for the stock market, oversold, and the sentiment numbers are bad. Whether it stabilizes going into early September is just a guess. Our advice has been to sell the rallies and just take and put your cash aside. We'd definitely be out of lower grade bonds. Well, we've been out of those things for a year now. And the other one is that the Treasury bond, as we use it with the ETF, the TLT, has had a terrific rally from a couple of months ago at 115, is now up to 126. It's now getting overbought, and traders in long treasuries would get out of the market, I think. I wouldn't short it yet, and investors, the ideal place for them would be in U.S. 3 to 4 year maturities on high-grade corporate bonds. You can't get hurt there. You'll make a better income than being in treasury bills. And for those outside of the U.S., you'll have the added bonus of the next leg up in the U.S. dollar, which, it could start within the next 4 or 5 weeks, I guess. So it's fascinating, Jim, to watch a financial storm as it starts, and then actually it gets rather depressing, because on this one, there won't be anything the policymakers can do, because they have been flat out doing things ever since they had this idea that crashes don't end. So going back to 2009, they turned the taps open, and they figured that they stopped the crash from going on for worse, and then they've never backed off. And so where they have no tools left to prevent the contraction when it finally came. So it's very ironical.
Well, I've heard some people say, well, they're just waiting for the Chinese government to come in with a major stimulus plan.
They bought hundreds of billions of dollars worth of stock in the crash. So then how much buying power has the Chinese central bank? And as a matter of fact, the European Central Bank has been buying bonds for the last 2 years. And the Fed, their bond buying program was completed, but I bet you they haven't sold anything. So, no, I think the policymakers don't have any more tricks left. And we'll see what Mother Nature and Mr. Margin do with that over the next month or so.
Mr. Margin, what a mean man.
Well, actually, no, when you look at it over your shoulder, the Fed is there to stimulate. And, in effect, they need speculators in order to expand their portion of the credit market. So then they're trying to get the accounts highly leveraged. And then when the prices start down, the job of the margin clerk is to get the accounts in line. And then you look back on 100 years of Fed existence, there's been 19 bear markets and 19 recessions. And in each one of them, when the contraction starts, the power swings from the central banker to the margin clerk. Or, that's on the stock market side, the margin clerk. But there's the loan officer at every lending institution, which then does the same thing. Your account's offside, get it onside, Sell out whatever you have to do. And it's as old as the hills. So we're watching it once again.
Well, apparently where the Fed lives, there are no hills. Bob, thank you very much for chatting with us.
Jim, good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com Radio. Our YouTube channel is Talk Digital Network. You can find us on Twitter at Talk Digital Net. You can forward questions or comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.